Okay.
So he knows a lot about business, as far as helping startup businesses and organizing people with their corporate affairs. And he has also a great passion for technology and has built that into his practice as well. So has a wealth of knowledge about, you know, cryptocurrency and the laws and things that go along with that. So I'll allow you to take it away, David.
Okay, thank you very much. So let's try and deal with the technology and share my screen. Let's see if this is going to work. I'm assuming you're seeing my screen now?
Yeah.
Okay. So you guys know about divorce, which I don't. I do, however, know about the tax aspects of divorce, separation, marriage, and everything between. So we'll go through and take a look at some of the implications of separating couples or divorcing couples. I think we can do it somewhat informally since we're a fairly small group. If you have some questions as we're going through it, by all means, use the technology to raise your hand and I'll see if I can figure it out. Or Linda hopefully will be monitoring it. Will let us know and we can
Yep.
try and do questions, and then we'll have a additional question session at the end if there's additional questions to be asked. So we're going to take a look at what CRA considers to be separated couples. With CRA, if you've had any experience with them, you know that everything can be controversial, everything can be a fight. Even the most benign, what we would consider to be benign issues can end up being a struggle to get it through to CRA. So can separated couples who live together be considered separate for tax purposes? You know, you and I all know that people separate, can't afford separate residences, but they end up living together. That can be a struggle with CRA. Then we're going to look at the transfer use of tax credits for separating divorcing couples. Part of that is the tax implication for family trusts or of family trusts for separating couples. We're going to look at generally the taxation of asset transfers in the context of a marriage breakdown, which will include a look at the attribution rules and the TOSI tax on split income rules. So we're going to start with CRA's definition of separated. What CRA says is separated is living apart from a spouse or common law partner for at least 90 days due to a breakdown in the relationship. So this definition precludes couples who reconcile their relationship within 90 days who are involuntarily apart due to school, work, or other circumstances. So the reality of a separated couple is a reality. We all know what a separated couple is. A common issue, common may be too strong a term, but not a rare issue, is clients coming in and saying, okay, can we say we're separated? And this is technically and in reality tax fraud. So it's something that we deal with. I imagine you guys have to deal with that as well. So you have to make it clear to would-be separated clients, separated couples, that separation is actually being separated, not just saying you're separated, not just pretending to be separated for whatever tax benefits you think there are going to be. Now, if you are no longer together after 90 days, then the full rules kick in. You can't say that you're separated if it's less than 90 days, and you can't say you're separated if it's a sham or a fraud. So the question is, can separated couples who live together be considered separate for tax purposes? So generally, in the eye of the CRA, separated couples who live together are generally not considered separated. So couples who have agreed to end their relationship without a legal divorce and who still live under the same roof may still be considered together in the eyes of Canadian law. So one of the older cases, tax law cases dealing with this is Smith. It's a 2003 Tax Court of Canada decision where he appealed a decision denying his GST tax credit claim. He claimed the credit because he was separated. The tax court dismissed the appeal on the basis that he was not entitled to the credit because he and his wife continued to live together under the same roof, and they remain cohabitating spouses within the meaning of the Income Tax Act. Therefore, Smith and his wife had not lived separate and apart and were not entitled, and he was not entitled to the tax credit that he was asking for. Now, a general exception to this rule is that if two individuals live under the same roof, but in their own personal self-contained quarters, they are considered separated and if they don't share parenting and financial responsibilities. Now, in some cases, there's a granny apartment in the residence, so this is an easy test to meet. In most cases, you don't have fully self-contained living quarters. I mean, how many normal houses have two kitchens? I mean, two bathrooms, not uncommon, obviously multiple bedrooms, but the two kitchens is, of course, the big issue. So you could certainly do a renovation to install a kitchen or a kitchenette or equivalent in one of the existing bedrooms or other space, but it entails cost, time, effort, inconvenience. So, decision in 2008 tax court in Oxygenatis is an exception where the CRA may recognize separation even when a couple shares a residence. So the tax court ruled in favor of the appellant who claimed tax credits based on her separated status, even though she and her former partner lived together. The court's decision hinged on the following factors: financial independence, specifically the couple maintained separate finances, separate bank accounts, separate credit cards. They were financially separated, and they had separate living spaces. They occupied different bedrooms and had distinct living areas within the home. The fact that they may have shared a kitchen or may have shared some other common areas like a living room does not mean that they were living together. They really had separate space within the same home. Presumably, they were not yelling at each other constantly. They were able to share a residence. So the fact that they were cordial, that had some sort of friendly relationship, again, does not mean that they were not separated. Now, conjugal relationship can be a problem. So if they are occasionally sharing a bed, this gets over the line of whether they are in fact separated or not. So the advice, if we're being asked for bedroom advice, is don't. Now, typically we're not going to get asked for that advice, but if it comes to a question in presenting the case with CRA and you were in a conjugal relationship, there may be a problem in meeting the test. It's also important to notify the CRA of your separation so that they can adjust the credit and benefit payments that may be affected by a change in the family situation and household income. So there should be standard advice to any separating or divorcing couple. Make sure CRA is notified of your status. And obviously, if you're changing address, change address. If you're maintaining the same address because you're separate under common premises, then you have to notify, well, you're not going to change your address, but you'll notify them that you're still separated. Let's turn to tax credits for separating couples. So as you presumably know, a tax credit is a dollar for dollar reduction on the amount of taxes a taxpayer owes. It is considered, because it is more beneficial than deductions, since tax credits are applied directly to reduce the amount a taxpayer must pay. Individuals in the same economic unit, that's to say a married couple, enjoy numerous tax benefits. This typically includes being able to transfer unused tax credits to each other to lower the overall tax liability. However, when the relationship ends, the best use of tax credits available to the separating individuals also change. Some new credits may become relevant, and the existing credits can no longer be shifted. Related to this is the medical expense medical expense deduction. So medical expenses to a married couple will be allocated between them in a tax beneficial manner. So if one couple can claim it in a more deductible manner, in a more of a deduction than the other one, then that is what can be done. This is another transfer that ceases upon separation. So start with the Canada Child Tax Benefits. The CCTB is a tax-free monthly payment made to eligible families to help with the cost of raising children under 18 years of age. Only one parent can claim the CCTB on their tax return, and the spouse who gets to claim the benefit will largely depend on the custody arrangement. If one spouse currently has full custody of the child, that spouse will be the parent who is eligible to claim the benefit. However, in the event of shared custody, they may have to split the CCTB with the ex-partner. The determination of whether or not the custody that a spouse has with the child is shared or full, and how the tax benefit will be split, is unfortunately made at the CRA's discretion, as are many of these determinations. So this is a common fight area with the CRA to prove that you are in fact separated and that you are in fact entitled to claim the child tax benefit. And proof is often demanded by CRA as to what the relationship is with the child and the parent who is responsible for taking care of the child. This will include, or the evidence we sometimes have to include, the evidence we sometimes have to submit will include evidence from, for example, the child's school, who will say, okay, it's the mother who comes to the meetings, or it's the father who comes to the meetings. It's the mother we call if there is a problem. It's the father we call if there is an issue. So this type of evidence is frequently required and has to be submitted to CRA to help buttress your case. The eligible dependent tax credit. It's a non-refundable tax credit designed for single adults who are not claiming the spouse common law partner credit and who are responsible for the financial care of a relative. To claim the credit, the dependent must live with you in the home you maintain. Only one of the separating partners can claim this eligible dependent credit. Utilizing unused transferable tax credits before the splits. Transferable tax credits allow spouses or common law partners to transfer their unused tax credit to one or another to minimize tax liability. It's useful if one partner has lower income and cannot fully utilize available credits. The following unused tax credits can be transferred in a relationship: the age amount pension, the income amount, the disability amount, the tuition amount, caregiver amount. However, once the couple is no longer considered spouses or common law partners for tax purposes, or they're separated, they cannot claim the transfer for that year. Okay, related to that is the tax implications on family trusts for separating couples. In Ontario, the Family Law Act governs property division when married couples separate, as you guys well know. Upon a split, the parties must calculate their net family property, and the party with the higher net family property makes a transfer to the other party for half of the difference. Typically, Outside the family law context, a beneficial interest in a trust is not considered a property. However, Section 4, Sub 1 of the Family Law Act expanded the definition of property to include any interest, present or future, vested or contingent, in real or personal property. This definition allows the court to, at its discretion, include trust property in the calculation of net family property when it is appropriate in light of all the relevant factors. Okay, the taxation of asset transfers. When couples separate or divorce, the rules governing the taxation of asset transfers change. So generally speaking, most asset transfers between separated spouses or common law partners are considered tax deferred. This means the tax liability is deferred until a future disposition of the asset by the recipient. Tax deferral means that the gain is not disappearing, it's just going to be recognized in a future period. Now, in order to defer the gain, the transfer has to be pursuant to a formal written separation agreement or a court order that's specifying the separation or divorce. Absent coverage under the relevant paragraph, 73 bracket 101 bracket B, there will be a disposition on transfer between spouses. So, types of assets that we typically need to deal with are the matrimonial home. Matrimonial home transfers are generally tax-free if the home qualifies for the principal residence exemption. If the principal residence exemption does not apply, the transfer is tax deferred and the transferee assumes the transferor's adjusted cost base. A family unit, while they're still a family unit, is only entitled to one principal residence exemption. So if you have a not atypical situation of a city home and a country cottage, then only one of those transfers will qualify for the principal residence exemption. The second one will qualify for a deferral, but will give rise to a full capital gain on sale. And as you probably know, the capital gains inclusion amount was increased as a result of the recent budget. So it's now 2/3 instead of 1/2 after $250,000 of gain annually. And remember, on the deferral, what will happen is the adjusted cost base of generally, but not always, the cottage is going to roll over to the spouse taking the cottage. So this type of tax equalization needs to be part of the negotiations of the separation or divorce agreement as to who is getting what compensation. Since the property that qualifies for the principal residence exemption will be sold completely tax-free, whereas the cottage is going to be subject to taxation when it's eventually sold. For other real estate, which would include the cottage example in this case, but it could be rental condos or anything else, or investment properties, transfers are tax deferred and capital gains will apply when the property is sold. For registered accounts, for example, RRSPs, TFSAs, they can often be transferred tax-free between separated spouses or common law partners under conditions outlined under the Income Tax Act. So, attribution rules are applicable to a married couple. Generally speaking, if one spouse transfers or lends property to the other, any income which would include interest, dividends, rental income, or capital gains generated from that property, may be or generally will be attributed back to the transferor spouse for tax purposes. What this means is that the transferor, not the transferee, will be taxed on that income or gain, even if the property is legally owned by the transferee. Purpose of the attribution rules is to prevent couples from artificially shifting income to a lower income spouse to reduce the overall tax burden. So this is one of the anti-income splitting measures that's been around forever. Attribution rules also apply for under 18-year-old children, not relevant in context of a divorce or separation, but just to complete the picture. So if you transfer assets to a child under 18, the income will be attributed back to the transferor. Capital gains will not be, and income on the income is not attributed back. So if you lend $100, you earn $10. The $10 is invested, the $1 earned the following year will not be attributed, although the $10 will be attributed back. So when couples separate or divorce, the attribution rules cease to apply. They end immediately upon separation of a common law couple, and they end immediately upon the finalization of a divorce for married couples. Attribution is also
David, can we just ask a question? So
yeah.
How long does that take how long is it that transfer situation applies?
Repeat the question. I'm not clear on it.
Let me go back and look at it. Like how long would the rule change for the transferor?
Along with the rule change forever. Sorry,
okay.
Are you asking pre-separation?
No, I mean, post.
Okay. I think he's answering the question right now. So I think the question was asked just as he was answering it. So,
right.
Okay, we're good?
We're good.
All right. So attribution is also suspended while spouses or common law partners are living apart due to a relationship breakdown. Income attribution suspension happens automatically. And for capital gains attribution, a joint election is required to stop capital gains attribution during the separation period. Which brings us to the TOSI or tax on split income rules. The TOSI rules were brought in, I don't know, 4, 5, 6 years ago, and it's part of CRA's further arsenal to prevent income splitting. There was a lot of income splitting happening. It was a very popular strategy we were using by shifting income from individuals in higher brackets to lower brackets. So the tax on split income targets certain types of income earned by individuals who are related to a business owner or a professional. So it's far more specific and focused than the general income attribution rules. And it's actually an expansion of what we call kiddie tax, which was the tax on income of under 18-year-old kids. So they expanded those rules to bring in general income splitting rules dealing with professionals or business income. So TOSI applies again for income splitting within a family unit, and on separation or divorce, there are provisions to mitigate its impact. So there's an exemption for separated couples, a key exemption for common law partners or separated spouses living apart due to a relationship breakdown. And while this exemption is beneficial for many separated couples, it's important to carefully analyze the specific facts and circumstances to make sure that you fall within the exemption in the case of a separation. And this went a lot faster than I expected, because that's the end of my prepared materials. So why don't we open it up for questions if there are any?
Could you expand a little bit on the TOSI rules then to say, you said in specific circumstances. So where would there be circumstances where it would be a problem?
Let me see if I can come up with an example. So there are provisions that are applicable to there are exemptions that are applicable in circumstances of transfers. No, not of transfers. Give me a minute to collect my thoughts here of how we're going to work this.
Sure.
Okay. So we have control requirements for TOSI to apply.
Renee has also said she has an example to help you out.
Sure, go ahead, Renee.
So I was working with a couple that had this type of arrangement. The husband was a realtor and had a business where he'd been flowing all his income, and his spouse was a stay-at-home spouse. And so yeah, it wasn't a problem. Essentially that as soon as they were considered separated, he could, before like when they were still considered not separated, and up until the separation agreement, he had been paying her dividends that were subject to TOSI. And then as soon as they were separated and had a court order to show that, he could continue to pay her dividends. So that's a pretty minor one, but it did allow him to transfer money out of his company to her without getting any kind of tax penalties. And it was just another way of figuring out how to move money between them.
So if we had a separate corporation that we're involving the wife in, that may or may not have affected the TOSI rules, but in your case, it's a very simple example, though. You're separated, so you can. I'm actually not able to come up with an example off the top of my head, sorry.
That's okay. Brendan has a question. Go ahead, Brendan.
Yeah, just a question on capital gains. So say, for example, there was an apartment building that was jointly owned between husband and wife. So on, or according to the separation agreement, say, for example, that the wife was going to take on the apartment building. So the husband would incur capital gains, correct?
No, it's going to roll over at cost.
Okay.
So the idea is that you have a husband transferring to wife.
Yeah.
So wife takes it at cost base.
Okay.
When she sells it, the capital gain will be incurred.
Okay.
So there is a pregnant capital gain there that you have to account for as part of your separation agreement.
Right. Okay. Okay. Gotcha. Yeah.
Anything else? Anybody else still awake, or I put everyone to sleep?
I have a question, but it's more around TOSI, and not separated couples. I thought you might know. So I have clients that are in, they're building cohab agreements. And so also relevant because many of us do that as well. And one of their accountants, the one spouse is a doctor and makes a fair bit of money and goes into her operating company, and then it goes into her holding company. And the accountant is saying that they can split income off of the investment income that is earned. So second generation income, they are transferring to the non-earning spouse and saying that that's going to be okay, that CRA is not going to catch that. I disagree, but I wasn't sure. if you know about that.
Off the top of my head, I think it's a problem, but you need to look into it more carefully. But the secondary income is,
I can't find anything. I just wondered if you knew more, but there's not a lot of guidance on it. So
I actually think there is some guidance on that specific scenario because it's not an uncommon scenario.
okay,
And I think there's pronouncements
keep looking. I
allowed.
haven't found anything that says yay or nay concretely yet, but it's a year later, so.
David, although you didn't include in your presentation, I think it would be useful to enlighten us a little bit about, the cryptocurrency and what tax rules are happening around that.
Well, it's going to be a rollover on separation or divorce. So what happens is the cryptocurrency needs to be valued and it's going to roll over at cost base.
So is the valuation where the problem comes in, or the challenge? Maybe not problem.
Well, it's not a tax issue. It becomes a valuation issue for separation of divorce purposes. And that's going to be a whole discussion because crypto is typically very volatile.
Right.
Bitcoin's bouncing around between 70,000 and 50,000 over the last 2 months. So where it is any point in time is an issue. So probably a fair way of doing it is taking an average for some period of time. But remember, again, it's going to roll over at cost to the spouse who's taking it or spouse who's keeping it, and it will be fully taxable when sold. And if you get into more complex arrangements such as well, mining is probably not relevant. If you've got a mining operation, you've got a mining operation. But if you have got a validation operation where you're pledging the currency and earning income off it, that's going to be attributable, and attribution will cease upon separation or divorce.
Is it treated then as a business?
Well, open-ended question. You can be carrying on a business involving crypto. It becomes a question of fact. If you are actively buying and selling, it's active income. If you are doing it buy and hold, it's probably a capital gain. You may have some altcoins that are some of the less known coins that are on income accounts because you're trading them, and then the staple currencies such as Bitcoin or Ethereum might very well be held for capital. So really it's function dependent. And if you're doing mining or staking or something like that, that might be a business.
Okay.
And then we're getting tangential now, but our advice, if you are doing that, is you should probably put it in a corporation. So then in the context of your separation or divorce, then you've got a separate corporation just dealing with the crypto that you have to deal with. And the disposition of those shares would roll over at cost as well, if they're going to the other spouse. It all goes back to basics.
Right.
So
and have you seen that work well?
Say again?
Have you actually seen where another spouse is willing to accept the crypto and that it flows through all right?
Remember, I'm not the divorce guy.
Yeah.
So I'm not going to see this. I'm going to get the consultation, and I haven't been consulted on this specific issue.
I have a question regarding the principal residence and cottage. So if, let's say, okay, so the cottage will roll over to the other spouse at ACB, but what if the spouse who now owns the cottage sells it first before the other spouse that, maintained the principal residence So that second spouse received the cottage at ACB and then flipped it or sold it and then claimed that as his principal residence.
Pass that by me one more time, please.
If I understand it correctly, I think the spouse that had the original principal residence, so to speak, would lose out.
So again, I'm not clear on the facts. So we have the city house and we have the cottage. We have
Yeah.
the husband keeps the city house, the wife gets the cottage. The wife then sells the cottage or the city house gets sold.
Yeah. So the husband kept the city house, which is where they lived, but after separating, she gets the cottage that rolls over to her at ACB. Then she sells it and claims that as her principal residence.
Well, you're going to have to deal with which is going to be the principal residence as part of your separation or divorce. Because otherwise, regardless, both spouses could try claiming.
Right.
So you have to deal with that issue up front.
Okay. So yeah. So that should be dealt at the separation level to ensure that that does not happen.
Right, because you are accounting for the potential capital gain on the cottage as part of your equalization payment. So the assumption is that property B, the cottage, is going to be sold and tax paid, which means right now you bought it 100, it's worth 1,000. There's $900 of capital gain. So we have let's just say it's a 2/3. So we have a $400 capital gain that we're going to have to pay on sale. So you've got to account for that. And any future appreciation is her responsibility.
Right. Okay, thank you.
Yeah, and Renee wrote in the chat that, I mean, generally in the agreement, it's going to identify what is the principal residence.
Exactly.
I don't know, based on my experience, that's a timing thing. So if the agreement's finished and signed, and then if it would be okay to sell, but if it's during the process, that's not going to work.
Well, during the process, both parties are going to have to consent to the sale.
Mm-hmm.
There's also usually a clause in there that says if one incurs a tax liability resulting from something that they did or didn't do, and it harms the other one, there's penalties or something. Like there's two clauses that come around this, who claiming and designated principal residence, and then there's just sort of a general liability type clause that I've seen in most separation agreements as a catch-all. So that if somebody does something that they shouldn't have done, there's a clause in there to protect the person who was hard done by.
What I have seen, which is outside of what you're saying, is where both spouses are offside the Income Tax Act, and my client, whichever one it is being advised by me to make a voluntary disclosure. So you then get into an issue of what happened to the other spouse. So typically what we recommend is that we file the voluntary disclosure and we advise the other spouse that we've done it and they should do their own voluntary disclosure. And if it's done pretty much immediately, CRA is going to have a hard time arguing that they were aware of the facts and rejecting the second voluntary disclosure. But it becomes certainly becomes an issue as to how to handle that situation.
I have a couple comments, although really not much questions. If no one else has any other questions right at the moment. One, just on the voluntary disclosure, of course, the liabilities at the date of separation would be liabilities on the net family property as well. So there'd be some challenge to determining the tax liability, not so much the tax liability, but the penalties that might, or interest that might be added on as well. But I wanted to go back to the capital gains issue just to raise a couple of points. One is everything is rolled over if it's part of the separation agreement, although one can elect out of the rollovers. So there may be a reason we want to trigger a capital gain at the date of separation. So that, we can override that standard provision. And the other thing with respect to the capital gain is that, as you said, David, the attribution stops after marriage breakdown with divorce. Some people go for the rest of their lives without getting the divorce and remain separated forever. And therefore, the capital gains can be attributed back to the original owner of the property unless there's an election filed for that as well. So the capital gains attribution can be avoided on that real estate if the appropriate election is filed. So there's a lot of things to think about with these capital gains when situations don't just flow as a normal rollover.
Yeah, and if you're dealing with securities and you have individual securities with uncrystallized losses, then you certainly want to elect and crystallize the loss at that time.
That's right, especially if someone's going to wind up with some losses and maybe not have future gains to use them. The other comment I'd just like to make back to trusts, which always scare me when we're going through a divorce and people have family trusts. I'm not in Ontario, so Ontario, and I think maybe BC, I'm not sure, specifically provides for trusts to be considered a net family property, but I read an article just last week from a law subscription that I follow, and while there was a discretionary family trust included in net family property, but the question was, what is the beneficiary's interest in that trust? Using a simple example, there might be $1 million in the trust being held, but there's 5 beneficiaries, and the trustee has discretion on who gets the money. And in the case I was reading about, the judge decided the trust had no value because there was no guarantee that any particular beneficiary was going to get any of that money. That gives me a problem. That gives me an ethical problem. I understand the law behind it, but it is something to be aware of, that these discretionary trusts may not have any value regardless of the amount of money there. It's good that we're not lawyers. The lawyers can argue those issues.
So that's the position I take when setting up discretionary trusts to protect against a potential CRA claim. So there's nothing for CRA because there is no guarantee that this discretionary beneficiary will ever have any assets.
Right, and which is the reason for the original Henson Trust, for other reasons.
Yeah, so it's a very effective strategy.
Not for the family looking to receive the value, but for the other side who are trying to protect it.
Yes.
Somebody has a raised hand, but I can't tell who you are. Oh, Carl.
Oh.
I think it's Carl.
It is me. Yes, it is me. Can everyone hear me?
Yeah.
Oh, good. I'm sorry. I've got a new office set up, trying to make sure everything works here. Yeah, I had one question about when it comes to secondary properties and doing a transfer, doing separation. Has it ever been done where you do it kind of like an estate freeze, where you pay the taxes now at the time of separation to bring the ACB back to 0 for the receiving spouse?
I was having audio problems, so I didn't catch the question.
Oh, all right. Let me try that again. So with secondary properties, let's say like rental properties, cottages, whatever the case may be, at time of separation, is there a potential of actually triggering the taxes then to the transfer so that the transferee ends up with an ACB of 0?
So you want to prepay the taxes?
Well, in a case like, for example, like I know from when we did a lot of planning when it came with clients that had cottages, like family cottages and so forth, and the astronomical amount of capital gains that does happen at that time at death. Is there a way of actually mitigating some of it by taking care of some of the taxes now versus dealing with it at the very bitter end? So if there's assets available from a non-registered standpoint to be able to pay some of the taxes now and calculate that within the net family property to be able to help the couple move forward.
So again, I'm having a little audio problems, but the gist of the question, I think, is you want to recognize the tax now, and the answer is, of course, yes. You can always elect out of the rollover. So if the cottage is worth $1,000 with a cost of $100, you take it at $1,000 and you pay the taxes on the $900.
Okay, so you can stipulate who's going to end up paying for that.
Well, there's going to be a disposition of whoever owns the cottage. So if it's joint, then both spouses are going to recognize half of the gain. If it is in the name of a single spouse, the transferor will recognize the gain.
Okay.
So you'll elect to transfer it at fair market value.
Does that happen at all, or am I just coming up with something?
Well, if you are a religious person, then the concept of prepaying tax from a tax point of view is considered to be heresy.
Okay.
So, I mean, you might come up with a scenario where it would make sense, but the general basic tax planning strategy is $1 deferred is $1 saved. So you never prepay tax. A lot of tax planning involves just deferrals.
Gotcha.
Rollover into a corporation technically is just a deferral. Eventually, whatever it is going to come out of the corporation will be taxed.
Okay. So there's no benefit to doing it that way.
I can't imagine what the benefit would be off the top of my head.
I'm going to chime in just because I've had some clients to trigger the capital gain because they had large capital losses to offset.
Okay, sure. Yeah, of course.
And then some people are crazy. Sorry, I shouldn't use that word, but some people want to pay the tax because they just don't want to think about any kind of debt at all. So I have had a client do that before where they transferred at fair market value and paid the tax on a property. They just wanted it done. And then they their principal residence from there on in. So
well, yeah, that's what I was thinking, because if you're transferring over a property, making it eventually your principal residence.
yeah. So that's what they did. They had two, I have to refresh my memory. They had two properties. They sold one of them, and then the other one they'd been renting out as an investment property, and one spouse took that one on. And yeah, he elected to do it at fair market value and paid the tax.
Now, did you have it? This is for separation. So did they share the cost of the tax?
No.
Okay.
They didn't.
So how did you put that on the NFP then to make sure that was fair and equitable?
I don't remember.
Okay. No. I'm just curious.
That was a long time ago, but I just, yeah.
Gail's got her hand up, and then Brendan. So Gail, go ahead.
Okay, so along the same lines, if you have a joint property, can one spouse say, I'd like to pay my tax half now? And then the property is transferred and the person who's transferring it into says, I don't want to pay, I want to carry mine forward at a different or an adjusted cost base? Or is it, if you're going to declare, you both pay your half now and it goes over to the new person at zero?
Well, look at the scenario. So we have a jointly owned property, and we have one spouse who wants to pay the tax. So if that spouse is taking over the property, then the election would be at fair market value. There would be a full capital gain. No, okay, so both of them, no, The spouse transferring is incurring a gain. The spouse receiving is not incurring a gain. This is not disposing. Yeah, I don't think so. Either way you slice it, there's going to be a disposition by the spouse doing the transfer. So the spouse who wants to incur the capital gain, oh yeah, okay, so the spouse who wants to incur the capital gain transfers to the other spouse and recognizes the gain. Yeah, okay, that would work.
Okay, Brendan, go ahead.
Okay, and I guess my question sort of for a bit further onto this as well, and I'm just looking at things and trying to figure out planning opportunities, but I'm wondering if there's some way that like a vendor buyback mortgage could happen there, like if the whole thing was trying to maximize the net worth and with the new changes in capital gains rules, like if there was an opportunity to have a vendor buyback situation in a separation, or has anyone heard of that?
I'm not following the scenario.
I don't think that is even an option when it comes to spouses and even separating spouses, because I'm not exactly sure. I'll look into that. I got a mortgage background, so I'll ask a few people, but off the top of my head, my gut feeling, the answer is no on that scenario. But I'll know for sure in a second. Hang on.
What is the scenario? So we have a property that we're selling and we're taking a vendor take back?
Or if it can be a vendor take back, could be from one spouse to another spouse. So the spouse that's taking over the property, if there's the ability to have a vendor take back in order to reduce some of the capital gains that would be incurred if they choose to elect to trigger capital gains.
A vendor take back is not going to reduce the capital gain. You elect to sell at cost, in which case it's deferred, and the vendor take back makes no difference, or you elect at market value, in which case the tax is paid.
But I mean, but the possibility of reducing taxes from, like, for the capital gains exemption from 50 to 66 and 2/3 if we're under that 250, right?
You're talking about staggering?
Yeah, like over a 5-year period or something.
I'm not sure how the reserve ties into the increased capital gains exemption. Sorry, the increased capital gains inclusion.
Okay.
So there may be a possibility of recognizing 250 a year over potentially 5 years as the vendor take back gets paid out. I don't even know if they've pronounced it. I'm sure they haven't done any rules on it yet.
Okay.
So they haven't answered that question yet.
Okay.
I have read somewhere that would work, but again, like
Risky.
David, I wouldn't hang my hat. I have read an article saying that would work, so it may be a possibility.
Depends if you want to be the brave person to test CRA.
I think we just need to see the final legislation for sure.
Oh, that's it.
Yeah,
Once
for sure.
the legislation, we'll know.
Well, any further questions?
I have a question. It's more accounting kind of like, so I have a couple who was going through divorce, but officially they haven't done that. And the spouse passed away. So it's more like estate planning question in some ways. So what he did for one of his RRSPs, he put his child as a beneficiary. So, and now the question, like they still married with the wife. So this is, I said, a little bit more kind of estate planning. So right now his estate gonna pay the taxes on that amount, which is going to be transferred to his child. Am I correct?
Sounds like it.
Right? So, and if the husband, he had the capital losses, which is carried over from 90s, so about 200,000. So it's supposed to be like taxes supposed to be covered by capital losses.
If there's capital gains on disposition on death, then those could be offset by the losses carried forward for sure.
Just the capital gains, or this RRSP gonna go into it as income, and I think final tax is supposed to be like you can claim it as like income, the whole amount. I think it's over 100,000.
How old is the child?
He's adult. He's 28, 29.
Yes. I mean, even if, so they could transfer it to the spouse now on a tax deferred basis, but if you transfer it to a non-spouse, an RSP, and you pass away, 100% is taxable in the year of death to the person that passed.
Right.
Otherwise,
So,
it falls to the spouse. They're no longer spouses, and can't do that either. So
I think there's also a will and estate issue here, that the spouse who's left needs to have it verified with the overall assets, because there's something that has to do with you're the spouse that's left. You could either be under separation, what you would have received for equalization, or under death, if it being different, and if some of those assets are going to a child. So I'd have that person check in with their family law, will and estate lawyer.
Yeah, will, it says nothing. So because it's a seg fund, so it has a beneficiary. So that's what he did. He changed it to beneficiary, and it's his son. So that's why question is, who is going to pay taxes on that amount? Is it going to be a state, or which is going to be covered by capital losses, or it's going to be like, I'm not sure about that. So that's
So
the
correct me if I'm wrong, anyone, but on date of death, the RSP is deemed income on the deceased tax return. Likewise, or also any unused capital losses can be used against regular income. So those unused allowable capital losses will reduce that RSP income, and the child who receives it gets it free and clear unless there's not enough money in the estate to pay the taxes.
What's going to happen if no money in the state? Because it's no money in the state.
Then if the estate is effectively bankrupt, CRA has the ability to go to the beneficiary to collect the taxes.
Oh, they can do that.
Yes, they can.
Okay. So thank you. So I'm going to send you to the estate lawyer to try to figure out. We just start talking about capital losses, capital gains. I'm like, I'm going to put my 2 cents. Okay, but thank you. Okay, I'm good.
Any other last questions for David? Okay, well, thank you very much for spending your time and teaching us a few things more about the tax world, and enjoying the rest of your day.
Thank you, Linda. It's been a pleasure. Thanks, everybody.
Yeah.
Have a good day.
Thank you.
Bye-bye.
Bye.
Linda, can you stay on the line here for a moment?
Yes, for sure.
And I wanted to ask you a question as well once you finish recording. And
Oh, okay. I can stop recording.